40 million people have read Rich Dad, Poor Dad. It's the best-selling personal finance book of all time, and the vast majority of those 40 million readers are still broke. Now, why is that? Is the book completely useless? No. Robert Kiyosaki teaches some genuinely valuable lessons about mindset, about assets versus liabilities, about not working yourself to death in a job that makes someone else rich. Those ideas have merit. I won't argue with that. But here's the problem. When it comes to the stock market, when it comes to building real, lasting wealth through equities, Rich Dad, Poor Dad leaves out the only lessons that actually matter. It teaches you to think like an entrepreneur, which can be useful. But it does not teach you how to invest in stocks like someone who wants to retire rich. In fact, Kiyosaki's philosophy, when applied to the stock market, can actively make you poorer. Because his worldview is built around timing, leverage, fear of crashes, and chasing alternative assets like gold and silver. Meanwhile, the people who actually got obscenely wealthy in stocks, people like Charlie Munger and Warren Buffett, did the exact opposite. They bought boring companies, held them for decades, ignored the noise, reinvested dividends, and compounded their way to billions without ever reading a single crash prediction or buying an ounce of gold. So today I'm going to walk you through the stock market lessons Rich Dad, Poor Dad never taught you. The lessons that, if you'd known them 20 years ago, could have made you $500,000 richer by now. And I'm going to show you exactly what Charlie Munger did instead for 60 years that Kiyosaki won't tell you about. Because here's the brutal truth. Kiyosaki teaches you how to look rich. Munger taught you how to be free. One of them died a billionaire who never had to sell fear to make money. The other has a podcast where he predicts crashes every 6 months and sells you gold. Choose your teacher carefully. Let's start by being fair. What does Rich Dad, Poor Dad actually teach? The core message is simple and in many ways correct. Don't work for money your whole life. Make money work for you. Assets put money in your pocket. Liabilities take it out. Your house is not an asset if it's costing you money every month. Your job is not security. It's a trap. Kiyosaki rails against what he calls the rat race. Go to school, get a degree, work 40 years, retire on a pension that barely keeps you alive. He's not wrong about that being a rubbish plan for most people. He's absolutely right that financial education is not taught in schools and that most people are financially illiterate. He also emphasizes entrepreneurship, real estate, building businesses, taking control of your financial destiny instead of handing it over to an employer. Again, useful ideas. But here's what the book does not teach you. It does not teach you how to invest in the stock market for the long term. It does not teach you about index funds, about compounding, about tax-advantaged accounts like Roth IRAs or 401ks. It does not teach you that the S&P 500 over any 30-year period in history has made patient investors wealthy without requiring them to time crashes or flip properties. In fact, Kiyosaki is openly dismissive of stocks. He sees the stock market as rigged, as something for insiders, as a casino where the little guy always loses. He warns constantly about crashes. He promotes gold, silver, Bitcoin, real estate with leverage. He talks about getting out before the crash and protecting yourself from the system. That mindset, when internalized by beginners, leads to one outcome. They never invest in stocks at all. Or if they do, they try to time the market, panic sell during dips, chase shiny objects, and end up poorer than if they'd done nothing. Warren Buffett has said repeatedly that the best investment most people can make is a low-cost S&P 500 index fund held for decades. Charlie Munger spent 60 years buying great businesses and sitting on them. They didn't time crashes. They didn't hoard gold. They didn't flip assets. They just bought quality, stayed patient, and let compounding do the work. Rich Dad, Poor Dad does not teach you that. It teaches you to be suspicious, to look for shortcuts, to avoid the system. And in doing so, it keeps millions of people out of the very wealth-building tool that could have made them rich. So let's go through, one by one, the stock market lessons Kiyosaki left out. The lessons that, if you apply them, will make you wealthier than any real estate seminar ever could. The first and most glaring omission in Rich Dad, Poor Dad is this: tax-advantaged retirement accounts. Kiyosaki barely mentions them. And when he does, it's usually to dismiss them as part of the old system or to complain about contribution limits. But here's the reality. If you ignore Roth IRAs and 401ks, you are leaving hundreds of thousands of dollars on the table. Let's start with the Roth IRA. You can contribute up to $7,000 a year as of 2024, or $8,000 if you're over 50. That money grows completely tax-free for life. You never pay capital gains tax. You never pay tax on dividends. When you retire and pull the money out, it's yours, free and clear. Now do the maths. If you max out a Roth IRA every year from age 25 to 65, that's 40 years of contributions. At an average 10% annual return, which is roughly what the S&P 500 has delivered historically, you end up with about $3.3 million. Tax-free. Just from putting $7,000 a year into a boring index fund and leaving it alone. Rich Dad, Poor Dad does not tell you that, because it's not exciting. It's not entrepreneurial. It doesn't involve leverage or flipping or beating the system. It's just patient, disciplined, compounding. And that bores Kiyosaki. Now let's talk about the 401k. Most employers in the US offer some kind of match. Meaning if you put money into your 401k, your employer puts in money too, up to a certain percentage. That is literally free money. If your employer matches 50% of your contributions up to 6% of your salary, and you earn $60,000 a year, that's $1,800 a year in free money just for participating. Over a 40-year career, that employer match alone, invested at 10%, grows to over $860,000. That's nearly $1 million you get just for not being an idiot. Charlie Munger and Warren Buffett have said over and over again, take the employer match. Max out your Roth IRA. Invest in low-cost index funds. Do not try to be clever. But Rich Dad Poor Dad skips all of that, because Kiyosaki wants you focused on real estate deals and starting businesses and avoiding the trap of working for someone else. Meanwhile, millions of people who followed that advice missed out on literal millions of dollars in tax-free compounding. If you're a beginner investor in the US and you're not maxing out a Roth IRA and grabbing your 401k match, you're making a massive mistake. And Rich Dad Poor Dad will never tell you that. The second lesson Rich Dad Poor Dad never teaches you is the power of index funds. And this one is absolutely criminal, because index funds are the single most proven way for ordinary people to build extraordinary wealth in the stock market. What's an index fund? Simple. It's a fund that owns a little piece of hundreds or thousands of companies all at once. You buy one share of an S&P 500 index fund, and you now own tiny slices of Apple, Microsoft, Amazon, Google, Coca-Cola, Visa, every major company in America. You don't have to pick stocks. You don't have to time the market. You don't have to be clever. You just own the entire market and let it grow over time. Warren Buffett has said repeatedly in his annual letters, in interviews, in his own will, that the average person should invest in a low-cost S&P 500 index fund and do absolutely nothing else. Charlie Munger agreed. He said most people are not qualified to pick individual stocks, and they shouldn't try. Just buy the index, reinvest the dividends, and wait decades. The historical data backs this up completely. The S&P 500 has returned about 10% per year on average over the last century. Some years it's up 30%. Some years it's down 20%. But over any rolling 30-year period, it has never lost money. Never. If you held for 3 decades, you made money. Every single time. Now let's do some simple maths that Rich Dad Poor Dad will never show you. Suppose you invest $500 a month into an S&P 500 index fund starting at age 25. That's $6,000 a year, which fits neatly into a Roth IRA. You do this for 40 years until you're 65. You never try to time the market. You never panic sell during crashes. You just keep putting in $500 a month, like clockwork, no matter what the news says. At 10% average annual return, you end up with roughly $3.16 million. You contributed $240,000 of your own money over 40 years. The other $2.9 million came from compounding. That's not speculation. That's not luck. That's just maths and patience. Charlie Munger did not get rich by flipping properties or buying gold or predicting crashes. He got rich by buying great businesses, Coca-Cola, See's Candies, Apple through Berkshire, and holding them for decades while they compounded. Index funds let you do the exact same thing without needing to be a genius. But Kiyosaki doesn't teach this. Why? Because it's boring. It doesn't require seminars. It doesn't require you to buy his courses or attend his real estate workshops. You can set up a Roth IRA with Vanguard or Fidelity in 20 minutes, automate $500 a month into an S&P 500 fund, and never think about it again. That strategy makes you a millionaire. but it doesn't make Kiyosaki any money. Instead, he tells you the stock market is rigged, that you need to be an insider to win, that you should focus on real estate and gold and getting out before the crash. And millions of people who believed that stayed out of the market entirely during the longest bull run in history. From 2009 to 2021, the S&P 500 went up over 400%. If you'd invested $10,000 in 2009 and just sat there doing nothing, you'd have had over $50,000 by 2021. Meanwhile, Kiyosaki spent that entire period warning about crashes, promoting gold, and telling people to avoid stocks. His followers missed one of the greatest wealth transfers in modern history, all because they were taught to be scared of the very thing that was making other people rich. Munger lived through the Great Depression, the 1973 crash, the 1987 crash, the dot-com bubble, the 2008 financial crisis. He saw it all. And you know what he did during every single one? He held his stocks. Often, he bought more. Because he understood that crashes are temporary and compounding is forever. Rich Dad, Poor Dad teaches you to fear crashes. Munger taught you to ignore them. One mindset keeps you poor and paranoid. The other makes you a millionaire. If you're a beginner and you take nothing else from this video, take this. Open a Roth IRA. Buy a low-cost S&P 500 index fund like VOO or VTI. Automate contributions every month. Do not check it every day. Do not panic sell when the market drops. Just let it sit there and compound for 30 or 40 years. That's the lesson Rich Dad, Poor Dad never taught you. And it's the lesson that could have made you a millionaire by now if you'd known it 20 years ago. The third lesson Rich Dad, Poor Dad fails to teach is the most important one of all. Patience beats timing. Every single time. Kiyosaki's entire philosophy is built around being smart with your money. Spotting opportunities, getting in early, getting out before the crash. He talks constantly about cycles, about knowing when to buy and when to sell, about protecting yourself from the next downturn. It sounds intelligent. It sounds like you're in control. But here's the problem. Nobody can consistently time the market. Not you. Not me. Not Robert Kiyosaki. Let me tell you something I've watched play out over and over again for nearly a century. The people who try to time the market, the ones who think they're clever enough to get out at the top and back in at the bottom, almost always end up poorer than the people who just sat still and did nothing. Why? Because timing requires you to be right twice. You have to sell at the right time and buy back in at the right time. Miss either one, and you lose. And the data is brutal on this. Study after study shows that the vast majority of people who try to time the market underperform those who simply buy and hold. There's a famous study that looked at the 20-year period from 1993 to 2013. If you invested $10,000 in the S&P 500 and just left it there, doing absolutely nothing, you'd have ended up with about $58,000. A 9.2% average annual return. Not bad. But if you missed just the 10 best days in the market during those 20 years, your return dropped to 5.4%, and you'd have only $28,000. Miss the best 30 days? You're down to $15,000. You barely broke even. Now here's the kicker. The best days in the market almost always happen right after the worst days. They come during crashes, during panic, during times when people like Kiyosaki are screaming on podcasts to get out and buy gold. If you're sitting on the sidelines waiting to time your re-entry, you miss the recovery. And missing the recovery is what kills your returns. Charlie Munger understood this better than almost anyone. He used to say, "The big money is not in the buying or the selling, but in the waiting." He didn't try to dodge crashes. He knew they were coming. He just didn't care. Because he also knew that over the long run, over decades, the market goes up. Always has. And sitting through the bad times is the price you pay for the good times. Warren Buffett has a saying, "The stock market is a device for transferring money from the impatient to the patient." That's it. That's the whole game. Kiyosaki teaches impatience. He teaches you to look for the next opportunity, the next cycle, the next get out before it's too late moment. That mindset keeps you constantly moving, constantly second-guessing, constantly looking over your shoulder for the crash. And while you're doing all that, the people who just bought an index fund and went to sleep are getting quietly, boringly, absurdly rich. Let me give you a real example. In March 2020, when COVID hit, the market crashed about 35% in a matter of weeks. Kiyosaki was all over social media saying the crash was here, the system was broken, get into gold and silver. A lot of his followers panicked and sold their stocks. They thought they were being smart, protecting themselves. But by August 2020, just 5 months later, the market had fully recovered. By the end of 2021, it was up massively from pre-crash levels. The people who sold in March and waited for the right time to get back in, most of them never did. They sat on the sidelines, waiting for another crash, while the market doubled. They lost fortunes by trying to be clever. Meanwhile, the boring, patient index fund, investors who did absolutely nothing made money hand over fist. They didn't time anything. They didn't predict anything. They just held. Munger held through 1973, when the market dropped nearly 50%. He held through 1987, when it crashed in a single day. He held through 2000, through 2008, through 2020. He never sold out of fear. He never tried to get cute with timing. And by the time he died, he was worth billions. Rich Dad, Poor Dad does not teach you that kind of patience. It teaches you to be active, to look for angles, to be smart about cycles. And that philosophy, when applied to stocks, turns beginners into nervous traders who buy high, sell low, and end up broke. Here's the brutal truth. If you can't sit still and watch your portfolio drop 30% without selling, you don't deserve the gains when it goes up 50%. The ability to do nothing, to ignore the noise, to stay invested through crashes, that is the skill that makes you rich. And it's the one skill Kiyosaki never teaches. So, Stop trying to time the market. Stop listening to people who predict crashes for a living. Just buy quality assets, or better yet, buy the whole market through an index fund and wait. Wait years. Wait decades. Let compounding do the heavy lifting. That's what Munger did. That's what Buffett did. And that's what Rich Dad Poor Dad will never tell you to do. The fourth lesson Rich Dad Poor Dad completely ignores is the power of dividends and reinvestment. And this is one of the most quietly devastating omissions in the entire book. Because dividends, when reinvested over decades, are responsible for a massive chunk of stock market returns. Let me explain what dividends are for anyone who's new to this. When you own shares in a company, some companies pay you a small amount of cash every quarter just for being a shareholder. It's usually a few % of the share price per year. Not much. But over time, it adds up in ways most people don't understand. Here's the thing. You have two choices when you receive a dividend. You can take the cash and spend it, or you can reinvest it using that cash to buy more shares of the same company. And if you choose to reinvest, something magical happens. Those new shares start paying dividends too. And those dividends buy even more shares. And those buy more. It compounds. Silently. Relentlessly. There's a study that looked at the S&P 500 from 1960 to 2020. Over those 60 years, the index itself went up about 78 times. Impressive. But here's the shocking part. If you reinvested all the dividends, your total return wasn't 78 times your money. It was 280 times your money. Let me say that again. Dividends, when reinvested, accounted for more than 2/3 of the total return of the stock market over 60 years. Not stock price growth. Dividends. The boring, unsexy, automatic payments that most people ignore or spend on nonsense. Charlie Munger and Warren Buffett understood this from the very beginning. When Berkshire Hathaway bought stakes in companies like Coca-Cola, American Express, Apple, they didn't just sit there hoping the stock price would go up. They collected dividends, year after year after year. And those dividends either got reinvested into more shares or used to buy other businesses. That's how they compounded wealth at rates most people think are impossible. Munger used to say, the first rule of compounding is never interrupted unnecessarily. Dividends are compounding in its purest form. You own shares. The company pays you. You buy more shares. The company pays you more. You buy even more shares. It never stops. And over decades, it turns small investments into fortunes. Let me give you a real example. Suppose you invested $10,000 in the S&P 500 inches 1,990 and just left it there, never adding another penny. By 2020, with dividends not reinvested, you'd have about $90,000. Nice. But if you reinvested the dividends, you'd have roughly $200,000. Same initial investment. Same 30-year period. The only difference is clicking a button to reinvest dividends. That one decision more than doubled your wealth. Now, does Rich Dad, Poor Dad teach you any of this? No. Kiyosaki barely talks about stocks in the first place, and when he does, he's dismissive. He doesn't explain dividend reinvestment. He doesn't walk you through the mathematics of compounding income. He's too busy telling you to buy real estate with other people's money or hoard gold because the dollar is collapsing. But here's what kills me. Dividend reinvestment is automatic. When you set up a brokerage account with Vanguard, Fidelity, Schwab, any of them, there's a little checkbox that says reinvest dividends automatically. You tick it once, and from that point forward, every dividend you earn buys more shares without you lifting a finger. You never see the cash. You never get tempted to spend it. It just compounds in the background while you live your life. That is exactly the kind of system Munger loved. Simple, automatic, disciplined, no room for human error or emotion. You set it up once and let mathematics do the work. But Kiyosaki never teaches this because it doesn't require you to be clever. It doesn't require seminars or courses or insider knowledge. You just tick a box and wait decades. That's it. And waiting decades doesn't sell books or fill conference halls. So millions of Rich Dad readers either avoid stocks entirely, or if they do invest, they take dividends as cash and spend them. They treat dividends like a paycheck instead of treating them like the compounding engine they actually are. And in doing so, they give up hundreds of thousands, sometimes millions, in long-term wealth. Here's another thing most people don't realize. Dividend-paying companies tend to be stable, boring, profitable businesses. Coca-Cola, Procter & Gamble, Johnson & Johnson. Companies that have been around for 100 years and will probably be around for another 100. They're not sexy. They're not going to double overnight. But they pay you every quarter, rain or shine, crash or boom, and those payments grow over time. Munger loved these kinds of businesses. He called them wonderful companies at fair prices. Buffett built an empire buying them. And a huge part of their returns came not from stock price appreciation, but from dividends quietly compounding in the background. If you're a beginner investor and you want to build real wealth in the stock market, here's what you do. Buy an S&P 500 index fund. Turn on automatic dividend reinvestment. Add money every month. Then forget it exists for 30 years. That strategy, boring as it sounds, will make you wealthier than trying to flip properties, time crashes, or chase gold like Kiyosaki tells you to. Because dividends don't care about your opinions. They don't care about market sentiment. They just keep paying, keep compounding, keep building wealth in the background. And Rich Dad, Poor Dad never tells you that, which is why so many of its readers stay broke. So, let's bring this all together. Rich Dad, Poor Dad sold 40 million copies. It changed a lot of people's thinking about money. It woke them up to the idea that working for someone else your whole life might not be the best plan. That financial education matters. That you should think like an owner, not an employee. Those are good lessons. I won't take that away from the book. But when it comes to the stock market, when it comes to building real, lasting, compounding wealth through equities. Rich Dad, Poor Dad is not just incomplete, it's actively harmful. Because it teaches you to be suspicious of stocks, to see the market as rigged, to focus on timing, on crashes, on getting out before disaster strikes. It tells you to chase real estate with leverage, to hoard gold and silver, to avoid the system that the rich supposedly control. And in doing so, it keeps millions of people out of the very investment vehicle that has created more wealth for ordinary people than anything else in history. Charlie Munger didn't avoid the system. He used it. He bought stocks in boring, profitable companies. Coca-Cola, See's Candies, Costco, Apple. He held them for decades. He collected dividends. He reinvested. He ignored crashes. And by the time he died at 99 years old, he was worth billions. Warren Buffett did the same thing. He's told the average person over and over again that they don't need to be clever. Just buy a low-cost S&P 500 index fund. Add money every month. Reinvest dividends. Hold for 30 or 40 years. That's it. That's the entire strategy. And it works. Mathematically, historically, reliably. But Kiyosaki never teaches you that. Because it's not exciting. It doesn't require you to attend his seminars or buy his courses. It doesn't make you feel like an insider who's beating the system. It just makes you rich. Slowly, quietly, without drama. And that's the difference between Kiyosaki's philosophy and Munger's. Kiyosaki teaches you how to look rich. Fancy cars, real estate portfolios, talking about leverage and cash flow and being an entrepreneur. It's performative wealth. It's wealth as identity. Munger taught you how to be free, not free in some abstract philosophical sense. Free in the most practical, tangible way possible. Financially independent, able to do what you want, when you want, without answering to anyone. And that freedom doesn't come from flipping properties or timing crashes or hoarding gold. It comes from owning assets that compound over decades. Assets that pay you while you sleep. Assets that grow faster than inflation, faster than your expenses, faster than your ability to spend. Stocks, when held patiently and bought intelligently, are the single best way for ordinary people to achieve that freedom. Not because I say so, because the data says so, because a century of market history says so. Now, let me be clear about something. I'm not telling you to put all your money in stocks and ignore everything else. Diversification matters. Real estate can be part of a portfolio. So can bonds, so can cash reserves. But if you're a beginner, if you're just starting out, if you don't have tens of thousands of dollars to throw at property deals or the time to manage them, the single most powerful thing you can do is this. Open a Roth IRA. Contribute the maximum every year. Buy a low-cost S&P 500 index fund. Turn on automatic dividend reinvestment. If your employer offers a 401k match, take it. That's free money. Automate your contributions so you never have to think about it. Then ignore the noise. Ignore Kiyosaki predicting crashes. Ignore the talking heads on financial TV. Ignore your friends bragging about crypto gains or day trading wins. Just hold. For decades. Do that, and in 30 years, you will be wealthy. Not looks wealthy on Instagram wealthy. Actually, genuinely, financially free wealthy. And here's the beautiful irony. The strategy I just described, the one Munger and Buffett have been shouting from the rooftops for decades, requires less work than Kiyosaki's approach. You don't have to find deals. You don't have to negotiate with banks. You don't have to manage tenants or flip properties or time the market. You just automate contributions and let compounding do the work. Less effort, better results. And yet most people won't do it. Because it's boring. Because it doesn't feel active or clever or entrepreneurial. Because Rich Dad Poor Dad convinced them that the stock market is for suckers and that real wealth comes from being smart with leverage and timing. But the data tells a different story. The millionaires tell a different story. Munger's life told a different story. He never flipped a property. He never timed a crash. He never hoarded gold or bet against the dollar. He just bought great businesses and held them for decades. And he died one of the richest, wisest, most respected investors in history. Kiyosaki, meanwhile, has spent the last 20 years predicting crashes, promoting fear, and selling products to people who are scared. His followers have missed one of the greatest bull markets in history. They sat on the sidelines holding gold and silver while the S&P 500 went up 400%. So here's my final word. If you want to look rich, follow Kiyosaki. Buy flashy things. Talk about cash flow and leverage. Post on social media about your investments. But if you want to be free, follow Munger. Buy boring stocks. Hold them forever. Reinvest dividends. Ignore crashes. And in 30 years, when Kiyosaki is still predicting the next collapse, you'll be sitting on a 7-figure portfolio, completely financially independent, laughing at how simple it actually was. Rich Dad Poor Dad is a fine book for mindset. But for the stock market, it leaves out the only lessons that matter. The lessons I just gave you. The lessons Munger lived by for 99 years. Now you know. What you do with that knowledge is up to you.